Good morning. Good morning. Thank you for tuning in to the morning show with yours truly, Dex the Algo Capitalist. All right, so we had more economic news that came out. We had the jobless claims. We have had NVIDIA earnings last night. What was it? PPI, I think, came out or something like that. So quite a few things going on today, and there is some volatility. The U.S. dollar index is down 3 pips at 104.89, and so the euro, the pound, and the Aussie are up slightly, 7 pips and 18 pips respectively. Bitcoin futures, though, it's the big story, down $1,580, trading at 68,235. And it did get down to 67,740. Ethereum, though, those futures are up $86 at 38.32 half. It did top out this morning at 39.65 half and hit a low of 37.41 half. Gold futures are absolutely rolling over it this morning, down $41.60 an ounce. Ouch. Trading at $2,351.30 an ounce. And then you have silver taking it on the chin as well, down 78 cents an ounce, trading at $30.71. It did just bounce off the low of $30.38 per ounce. And then, of course, the Dow was down over 300 on the Dow futures. Now it's bouncing off those lows. Dow futures hit a low of 39,451 just a moment ago. And the S&P is up 9.5 at 53.37 half. NASDAQ 100 was up well over 200 points, almost 300 points. It topped out, the NASDAQ 100 topped out at 19,022 half this morning on the futures. So that's a new all-time high and a new 52-week high. And the current price is 18,917 and 3/4. So it's pulled back a bit. Then, of course, the Russell My Hustle is down 12.4, trading at 2076.60. And that's just off the low today of 2066.30. It was able to get up to 2101.1 before rolling over. So we have a mixed bag here going on. And yes, a lot of news going on. And now the bears are starting to come out en masse. Now Jeffrey Gundlach believes winter is coming for the U.S. economy. The billionaire investor said interest rates will stay elevated, tanking companies and ultimately leading the economy into a recession. For the record, we're not in a recession, even though most Americans seem to think that's the case, because according to the Fed's numbers, we're not in a recession. But according to reality, which the market has been divorced from for quite some time, they're right, we're not in a recession. We're in an economic depression. Now, if you didn't think that that was outrageous enough, well, guess what? We had another fat finger mistake. Remember the flash crash of May the 6th, 2010? Well, this one hit Citi. In May of 2022, a trader mistakenly tried to execute a trade worth $444 billion, sparking a flash crash in European stocks. UK regulators levied a $78 million fine against the bank on Wednesday. Now, you may be thinking, how is that even possible? Remember, I've talked about this many years ago. Banks have different accesses than you or I. For the most part, they can do whatever they want, trade whatever block of whatever shares they want. They don't have the limitations that we have. They also have the ability to bust trades that they don't like. So if they take a loss, they can just bust the thing, bust the trade. Fannie Mae, Freddie Mac was famous for doing that on their trade in their trading pit. So if a bond trader had a bad day in the market, just pretend like it never happened. And they were allowed to do that. Pretty crazy, isn't it? I know, I know, I know. So we have another win for NVIDIA. The tech giant knocked it out of the park again on Wednesday when it posted better than expected quarterly sales figures. CEO Jensen Huang also touted strong demand for the firm's Hopper and Blackwell chips. We'll see how long this can continue to go. You have to admit, though, NVIDIA is moving like a meme stock at this point. Remember when AMC and GameStop a few years ago exploded? GameStop, in particularly, exploded from $23 to over $500 almost instantaneously. Yeah. Yep. That's exactly what happened. And now it's happening all over again. So the lunacy continues, but we know this. And so, what is it that they really are accomplishing here? What are they trying to accomplish? I'll tell you what they're accomplishing, whether they are privy to it or not. But what we are seeing is the weaponizing of global depression. Yeah, I know. I know. Let it marinate for a minute. Global depression. Now, let's consider the potential to weaponize global depression in the first place. The key to this dynamic is the asymmetries built into the global economy. One important asymmetry is energy, with exporting nations on one end and importing nations on the other. So, exporting nations of energy are producers, and the importing nations, on the other hand, are the consumers. A very small number of nations and regions occupy the middle. They export or import relatively little energy as they are largely self sufficient and can make do with what they produce themselves. They aren't reliant on exports for income or imports to keep their economies from collapsing. And another key asymmetry is currencies and bond markets, which are one integrated system. Currencies are valued by the liquidity, depth, risk premium, and yield of the bonds denominated in the currency. A lot of people have a lot of opinions about currencies, and unfortunately, many of these opinions are detached from the basic reality that currencies and bond markets are one system, not two. If a currency and its bonds don't trade freely on the global market, i.e., they're pegged to another currency, like the RMB to the USD, for example, or let's say capital control limits the liquidity and depth of the market for the bonds, this places intrinsic constraints on the risk characteristics and thus the value of the currency and the bonds. If the risk is high or difficult to measure, then demand for the bonds and currency will be limited. The issuing nation or central bank will be constrained in how much new currency or bonds it can issue without pushing the value off a cliff. Well, in other words, currencies and bonds backing them have asymmetric risk premiums, liquidity, and valuations. Now, for players in size, for example, sovereign investment funds, illiquid bonds are risky because when it comes time to dump their $10 billion stake, the market is bidless. There are no buyers in that size at any price. Therefore, risk is tricky. It tends to become visible only after it's too late. Yes, there are hedges. We know that. But at size, there are no hedges. Okay? A range of asymmetries arise between exporters of energy and consumers of energy in a global depression. Now, once demand for goods and services falls off a cliff, demand for the energy to generate those goods and services also falls off a cliff. As marginal demand is swept away, marginal enterprises, loans, and employment are also swept away. Far fewer people can afford to jet around the world and frequent restaurants, so demand for jet fuel, etc., also plummets. Now, energy consumers aren't concerned with the cost of producing energy. That's your problem. As the price of oil, natural gas drops below production costs, consumers are cheering, yay! Recall that price is set on the margins. If demand falls faster than production, price collapses. Producers care very deeply about the cost of production and the price of the energy they export. Therefore, energy exporters are still bound by the commodity curse. It's so easy to make money selling energy and so hard to compete in the global economy for other means of production. So the producers depend on selling energy for a consequential share of the national income. The exporters have no substitute for the share of their national income derived from exporting energy. The asymmetry in currencies and bonds plays out in the consumer nations. The few nations that can issue new currency and bonds without destroying the purchasing power of said currency can issue whatever currency they need to fund social welfare for those who lost their jobs. Yes, fewer people can afford pricey air travel and vacations and eating out every day, 3 times a day, but they'll make do with preparing food at home in much cheaper forms of amusement, such as offline video games. All right. Now, those nations that can't print more currency without destroying its purchasing power don't have this luxury. Belt tightening is all well and good until a nothing left to lose revolution sweeps away the ruling elite. The producer nations depend on energy exports, have a equality difficult set of constraints. They can try to cut production to make plummeting demand, but game theory strongly favors cheaters who announce production cuts but pump as much as they can to maximize revenues as the price of energy drops. Most energy exporters have built up savings in the form of central bank reserves and sovereign wealth funds, but they now discover another asymmetry in global depressions, which is the value of their stocks and bonds has now plummeted. And even precious metal prices are dropping even as we speak, as everyone is forced to liquidate savings to fund the exporters' insanely high social welfare and military expenditures. So they never want to group the two together when they talk about austerity and cutting entitlements. They want to separate that from the military spending budget, which the entitlements budget is dwarfed by the military budget. The military budget is endless. It's a bottomless pit. And not all the money that's earmarked is accounted for. It's considered classified on a need to know basis under black budgets and black programs. So then why would bonds lose value? As the demand for buyers of newly issued bonds explodes higher to fund deficit spending, bond yields rise globally as nations compete for the dwelling pool of capital willing to buy potentially risky bonds. As bond yields rise, the value of all existing bonds tumbles off the cliff. So, not only could energy revenues fall by half or more, the value of reserves could also fall dramatically. Nations dependent on energy exports will face a 1-2 punch with no viable plan B to replace energy revenues with revenues from some other source. Energy producers can cut production, but they'll still be selling fewer units for far less money. Energy prices below production costs are impossible until there's competition for declining consumer demand. The frictionless pathway is to slash prices to maintain national income and sell off the reserves and sovereign wealth fund assets to fund social welfare and, yes, military budgets. Yeah, well, this works for a while, but not for long. A global depression isn't just deeper than a recession, it's also longer. Depressions occur when all the policy gimmicks reach diminishing returns and they fail to restore growth in credit and consumption. So eventually, the energy exporters have to cut their government spending, and that will inevitably trigger social and political disorder. Their difficulties are painfully visible to all, and the demand for any bonds they issue will be low due to the risk that the national enterprise is spending far more than it's bringing in and therefore could go bankrupt. Did you know that the United States of America's debt to GDP just 3 years ago was north of 120%? Yes, the United States of America's debt to GDP just 3 years ago had already reached a staggering, eye watering level north of 120%. Add up these asymmetries, and we find a very few winners and many, many losers. The winners are limited to those nations with these next five capabilities or capacities. One, self sufficiency in energy, or close enough to manage the modest imports from friendly neighbors or allies. Number two, those not dependent on energy revenues for the bulk of national income. Third, the capacity to sell newly issued bonds without reducing the purchasing power of the currency, i.e., the risk premium and yield are more attractive than competing issuances of bonds. Fourthly, maintain a freely traded, i.e., price and risk discovered by the market, liquid market and size for its bonds. And fifthly, a diverse, adaptable economy that maintains deep, liquid, transparent markets for goods, services, risks, credit bonds, and other financial assets. I know, wishful thinking, right? How many people fit into those categories? Not many. So systems are defined by their constraints. Should oil fall to $40 a barrel and stay there due to declining demand, various constraints start limiting policy options. If savings are depleted to maintain the illusion of solvency, various constraints start limiting policy options. If there's no demand for newly issued currencies and bonds, various constraints start limiting policy options. So here are the messy realities that tend to generate the illusion that an array of policy options still exists. The Fed will have you to believe that they still have bullets in the chamber and irons in the fire. but that is just not true. Okay? Eventually, these will be pared away by the systemic asymmetries and constraints. All right? This is a fact. The most diverse adaptive economies with the largest and most transparent markets, again, free markets, all right, with price discovery being allowed, and the most balanced energy production and consumption will be the winners. And every other nation will struggle due to the constraints and asymmetries described a moment ago. It's just the way systems function. All this suggests a strategy that's only available to those few nations with all five capacities: weaponize global depression by jacking up bond yields and tightening credit so the increasingly fragile global economy slips off the cliff into a recession slash economic depression that quickly becomes entrenched into depression by decades of policy extremes that are finally generating unintended consequences that cannot be reversed nor ignored. The ensuing global depression will be bearable for those with the five capacities and a system breaker for everyone else. It's nothing personal, it's just business, right? Systemic asymmetrics and constraints present opportunities for the few and risks for the many. Talk about a zero sum game, right? Now, I'm not saying that weaponized global depression is inevitable or even likely. What I am exploring is the potential for global depression to be weaponized as a policy option or as an unintended consequence of actions that stretch asymmetries and constraints to the breaking point. So, where does that leave us as individuals and households? Well, it's best to take the long, emotionally detached view and devote ourselves to maximizing our own self reliance. The less we depend on high debt, high consumption, and fragile global systems, the better off we will be. And that is a fact. Something to think about for the rest of the day, right? Will we see the weaponization of global depression? And if so, who, which nations possess the five characteristics to be able to weather the storm? I hope you got something out of today's morning show. But now I must bounce. Remember, the system works if you work the system. Bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. And on that note, thanks for tuning in. Thanks for listening. Thanks for watching. Go to postwavetrading.com if you have not already done so and sign up for your daily attack reports. Trust me, you cannot live without them. Do not wait for the Rao situation to hit. Do not wait for Calamity Ganon to hit. Get prepared now. Everything you need to weather the storm is at postwavetrading.com in the form of these attack reports that inform you and keep you in the loop of not just what's happening, but what's about to happen before it happens. Like, share, and subscribe. Until next time, I'm out. Peace.